Hello students, welcome to Accounting Explained at AccountWise Academy. This is Lata Venkateshwaran. This is the part 1 video of NCERT chapter 2 Theory Base of Accounting of 11th Standard Accountancy portion. I have explained this chapter in a very simplified way and with lot of examples so that you can understand the lesson very easily. If you want to look into the important questions and MCQs of this chapter, you can see our shorts in our channel Accounting Explained at AccountWise Academy. The link of the chapter 1 will be shared in the description box for you to go through the chapter and understand the chapter very easily. Today we are going to cover the following topics for the chapter Theory Base of Accounting. They are Introduction to the chapter, Generally Accepted Accounting Principles, Basic Accounting Concepts, Business Entity Concept, Money Measurement Concept, Going Concern Concept, Accounting Period Concept, and the Cost Concept. We are going to see the introduction for the chapter. Okay. So, accounting tracks, analyzes, explains finances for various users. So, this tracks, analyzes and explains finances, all these things we have seen in the previous chapter. I am going to explain now also because these are all the basics. Okay. Now, let us take an example of a large car manufacturer. Accounting here tracks the cost of raw materials. What are the raw materials used by the car manufacturing company? Steel, rubber, etc. Then it takes expenses of labor, factory rent, electricity, etc. With that, they analyze them efficiently to see that they are producing cars in an efficient manner and they can identify the areas of cost reduction. Okay. And it is useful for various users. Who are the users here? Here, the users are internal users and external users. Internal users means managers, accountants. In total, we can say it is management. Next, external users means outside the company. That is creditors, investors, etc. Okay, let us see the second point. Useful information must be reliable and comparable across companies and time frames. So the information which we got from the first point should be reliable and it should be comparable. It should be easier for us to compare across companies. Across companies means, for example, X is one car manufacturing company and Y is another car manufacturing company. We should be able to compare them easily with the financial data available. So there should be some standard procedure for comparing. We cannot just compare the numbers. Okay. And time frames. Time frames means comparing one quarter with another quarter, half yearly with another half yearly, or with 1 year with another year. Okay. Accounting theory and practice ensure consistency in reporting. There should be consistency in reporting or theory and principles. Okay. For example, let us take an example like if we pay rent for whole year. Okay. The financial year starts from April 1 to March 31st. Okay. So if we pay rent for the whole year 24,000 and we prepare financial statements every year, April, May, June, every month, sorry. Okay, July, like that. We cannot take this 24,000 fully and we cannot decrease our profit in the April month. What we have to do is, we have to take 2,000 rupees for April month, 2,000 rupees for May month, 2,000 rupees for June month, etc. Okay, so that the profit for April month is not reduced drastically. If we take 24,000 fully in the April month, then the profit is going to be reduced. That is not correct, no, because we are not using the office space for the whole year in 1 month. Okay, only that month's rent can be taken for April month. So there should be consistency in reporting. Okay. Standardized rules like ICAI further promote consistency. This consistency has been ensured by ICAI, that is the Institute of Chartered Accountants of India, so that all the companies maintain financial statements in a particular manner so that it will be easier for us to compare those companies. Okay, when we see the financial statement itself. Consistent reporting empowers informed decision making by various stakeholders. For example, we will take the example of our own car manufacturing company. If our car manufacturing company is going to enter a new production line, that is, if you are manufacturing fuel based cars and if you are going to go for electric cars, this can be done by seeing the reporting. Okay, reports which we have generated. So it is helpful for decision making, or else if you are going to enter a new market, for example, if you cater only to South India and if you want to enter Northern India, that also can be done with this reporting, financial reports as the data available database. We can do those decision making also. So it is important for all this decision making. Generally accepted accounting principles. GAAP. Okay. Purpose. What is the purpose of GAAP? GAAP or rules and guidelines to ensure uniformity and consistency in accounting records. So previously we saw there should be consistency in reporting. So that is being given, all those rules and guidelines are being given by GAAP. That is generally accepted accounting principles. Definition. What is the definition of GAAP? They are defined as the accepted practices for recording and reporting business transactions. So business transactions can be done or recorded and reported only by using the generally accepted accounting principles. Okay. Importance. GAAP promote objectivity, reliability and comparability of financial statements for decision making. Okay. So we will just imagine, now we will imagine a large competitive world of laptop manufacturers. Okay, there is lot of competition, there are a lot of competitions among laptop manufacturers, that too after this COVID outbreak. Okay, so let us take that example. Each company wants to attract investors and customers by showing their strong financial performance. Okay, however, without standard accounting practices, comparing their financial statements would not be possible, right? So there should be some standard accounting practices for comparing. In simple words, GAAP equals all the laptop companies, ensuring everyone follows same rules and that financial statements are accurate and comparable. Okay, they are accurate and comparable. This benefits investors, customers and the whole industry. Okay. Evolution next. GAAP evolve over time based on experience, practice and user needs. See, GAAP is not same, did not remain same right from the day it was they started to practice GAAP. It has evolved over time. Okay, it has developed over time. That is based on the experience, how our accounting practices changes and according to the user needs. End user needs is the most important thing. No, according to the user needs, GAAP is also getting evolved. Okay. Basic accounting concepts. Basic accounting concepts are referred to as the fundamental ideas or basic assumptions. Now, these are the ideas or assumptions underlying the theory and practice of financial accounting and are broad working rules for all accounting activities and developed by the accounting profession. Okay, so they are the fundamental ideas or the assumptions that we are going to take for recording our financial accounting, and there are some rules for all the accounting activities and that has to be followed. we will see the most important concepts for the used in accounting. They are business entity concept, money measurement concept, going concern concept, accounting period concept, cost concept, dual concept or duality concept, revenue recognition or realization concept, matching concept, full disclosure concept, consistency concept, conservatism or prudence concept, materiality concept, and last objectivity concept. We are going to see all these concepts separately. Okay. Business entity concept. So we are going to see each concept separately now. So first concept is business entity concept. The concept of business entity means treating the business and its owner as separate for accounting. This is like two distinct people. Imagine your dad runs a grocery store. You and your dad are different people, right? Similarly, the store is different from your dad. So they are two distinct people. Your store and your dad are two different people. Owner invests money. Business owes this as a liability, that is money owed. Imagine your dad started the business with rupees 10,000 rupees and he has invested this money in the business. This 10,000 is considered as a loan from the shop's point of view, store's point of view. Okay. So it is considered as a liability. Meaning of liability is money owed. Next is owner takes money out. This reduces owner's capital and the business's liability. Imagine if your dad has taken rupees 2,000 out for his personal expenses from the business. Then his loan, that is getting reduced by rupees 2,000 and now his loan is only rupees 8,000. Okay. Accounting viewpoint. Records only business transactions and not owner's personal finances. Okay. The store only keeps track of its own sales and expenses. It does not take into account what your dad spends on your family. Okay, that is this point, accounting viewpoint. Next is only business funds matter. Only transactions involving business money are recorded. So the store only cares about its own income, not how much money your dad has in his purse. That is his own money, but the store is caring only about its own income. So it only transactions involving business money are recorded. Okay. Why this separation is done? This separation is important because it shows how the shop is doing. Okay. To find the performance of the shop first. Next is it prevents mixing up shop's income and expense with your personal income and expense. Then only we will be able to find out the exact profit the shop has earned. Okay. So even though it's your dad's shop, the shop has its own financial life. Now we will see the second concept, money measurement concept. Only measurable financial transactions are recorded in accounting. So consider you are running a tea stall with your friends. Okay. Accounting is like keeping track of your business using only money, that is using only financial transactions. That is using money means monetary value. Okay. Not the cups of tea or samosas you are going to sell. Okay. So it uses only rupees and paise, not kgs or quantities. Okay. Transactions are recorded in the monetary unit and not in physical units. That we see only, no. We write down transactions, how much cash comes in, like in terms of tea sales, etc., and how much cash goes out for purchasing sugar, for purchasing tea, for purchasing milk, etc. Okay. So this helps to summarizes the business's worth but has its own limitations. So we can find out the worth of the business, that is we can track everything in rupees. Okay. and we can understand the financial health of the company. That is the business worth, but has its own limitations. We write everything only in monetary value, but we do not consider the kgs or liters which we are going to sell. So there is some limitations over there. Apart from the quantity, tracking of quantity, there are other limitations also. What are those limitations are? See the next point, money value changes over time. So historical cost may not reflect the true value. See, when you record transactions using monetary value, it gives your stall's financial health as of today. But it do not project the future scenarios. Only today what you have spent and what you have earned it gives. It does not give the future projections. It considers only the money spent. That is called the historical cost. That is the current cost which you have spent is called the historical cost. That is already spent. No, that is why it is called as historical cost. Accounting data may not perfectly represent company's financial health. So accounting considers only monetary part of your stall, but does not take into account other factors like most important factor is customer satisfaction, quality of the tea sold, teamwork among the employees, etc. So it considers only the company's financial health. So these are all the limitations and of following money measurement concept. Going concern concept. So going concern assumption. What is the assumption you are going to take on the going concern concept? Businesses operate indefinitely, not closing soon. Asset value represents future services the asset provides. So same example we'll take our tea shop. Imagine you buy a fancy new tea making machine for your stall. So accounting has a special rule about this. What is that? It is that we cannot take the cost of the tea making machine directly to 1 year as we saw in the rent. No, similarly if the cost of the machine is rupees 1 lakh, we cannot take directly to the year which we have bought. So year 1 we have bought, assume we cannot take this directly to this year 1. Okay, so we assume that your stall will keep making tea for a long time. And when you buy the machine, they will say, you know, the life of the machine is 10 years or 5 years, etc. So let us assume they have told you that the life of the machine is 10 years. So this 1 lakh is not going to be taken in the year 1. It is going to spread for 10 years till the life of the machine. So 1 lakh is the cost of the machine. 1 lakh divided by 10 is 10,000 rupees. So every year you are going to take 10,000 rupees. Year 1, year 2, year 10,000, year 3 10,000, like that till the whole cost is exhausted. Okay, this is done because the machine is just not 1 year's expense. The machine is going to be used for a long time. So it will give you tea for many years. So accounting does this. Okay, it does not charge the whole machine cost to just 1 year. Instead, it spreads it over for several years, year 1, 2, 3. Think of it like the machine slowly using up its value each year. So it's using its value each year. So first year it has used we have used the value of the machine of rupees 10,000. Second year again we'll be using the 10,000, like that. So this spreading, no, 10,000, 10,000, 10,000, which we are spreading evenly, it's called as depreciation. Okay. So now you understand the concept. No, now let's go. Cost spread. Does not charge entire cost in 1 year, match it to revenue earned. So we are not taking this 1 lakh to year 1, but we are spreading it to the revenue earned. So for 10 years we are spreading. Depreciation. So this depreciation is for, no, this spreading is called the depreciation over assets useful life. Here useful life is 10 years. So that is depreciation. No going concern. Entire cost charged in the year of closure. If the company is going to close in the year 4. So year 4, how much depreciation you would have done? 10 into 4 is 40,000 you have done. So in the year 4, when you are going to close the business, whole 60,000 will be taken. End of the year 4 will be taken and that whole 60,000 will be charged this year. Okay, that year. Accounting period concept. Accounting period concept first takes into account, as the name suggests, accounting period, a regular time gap for company financial reporting. So financial reporting is done at a regular time gap. Usually it will be a year. Okay. Purpose. What is the purpose of preparing financial reporting? To understand profit or losses we have earned during that year, and to find out the financial position, where do we stand among other companies, or over times we saw, no, like that. So across companies, or with from one time from last year to this year, comparison over that period. Okay, for all these things it is called as financial position. Users. Who are the users? Internal users like managers, management, etc. External users like investors, creditors. They need this information regularly. Standard period. Annual statements are common. So usually annual statements will be prepared, but sometimes quarterly reports are also used. There are some exceptions. What are the exceptions? When there is partner retirement or public companies. Public companies may have different periods, that is they need to submit quarterly reports. In case of a public company that has given issued shares, no, those are called as public companies. For those companies they have to issue financial reports quarterly. In case of partners retirement also, they have to do financial reports immediately after the retirement. Okay, this we will study when we do the partnership accounts. So for this we can say that, take the same example of a tea stall. Like our school conducts exams regularly and issue report card stating our performance during that exam. No, similarly, financial reporting should be done rather regularly, to understand the performance of our tea stall, whether we are earning profit or loss, etc. Cost concept. Okay. So, assets are recorded at purchase cost, includes actual price, transport, installation and setup. Historical value matters. Cost stays the same even if market value changes. So, the cost remains the same even if the asset value increases or decreases according to the market value. The cost we have recorded remains the same. That is called the historical cost. Benefits. Makes record keeping objective and verifiable. Since it remains the same and does not fluctuate with the market value, it is easy to keep record of that. Okay, limitation. So it may not, the limitation is it may not reflect the true asset value, especially during inflation time. Hidden profit. So market value exceeding the book value. Book value is the value which we have recorded. Okay, that is a historical cost. Here's the historical cost. It may be the market value may be more than the book value, greater than the book value. Shows then our profit is underreported. Okay. So I am going to take an example and explain this to you very clearly. Suppose your grandpa gives you a land which was bought in 1980. Okay. Records show it cost rupees 5 lakh back then. Today, the value of the land, you can imagine, no, it will be in crores. Your land value is more valuable than what's written down in the documents. So the hidden worth, that is the difference between the market value, today it is in crores, but he bought it in 1980 only for 5 lakhs. The hidden worth is not reflected in the old price. This happens with many things, not just land. Okay. So historical cost might not capture the true value of things, especially when they appreciate over time. So that is what is explained here in the cost concept. Main thing is we have to understand is historical cost we record, and we do not consider the inflation part. That is the movement of price over the period of time. That is the market value of the asset. Okay. With this cost concept, we are going to finish the part 1 of our video of the second chapter. Okay. Do like our video and share it with your friends if you find it helpful. Subscribe to our channel, which will encourage us to make more videos like this one. If you would like to inquire about the accountancy classes which I take, or to get more worksheets for problems with solutions, contact us at acct.wiseacademy@gmail.com. Thank you for watching.